Have you ever noticed this? Two people invest in mutual funds, same market, same time period. One reaches his financial freedom, the other feels stuck and frustrated. Was it luck? No. It was the moves they made along the way. Today, I'm going to explain mutual fund investing in India using something all of us know very well, the game of snakes and ladders. Stay with me because by the end of this video, you will clearly know which moves help your money grow and which mistakes silently destroy wealth. Welcome to Kaapi Compounding. In snakes and ladders, the goal is very simple. Start at the bottom and reach the top. In investing, the goal is the same. You start with limited money and you aim for financial security, freedom, and peace of mind. But the path is never straight. There are ladders that push you forward and snakes that pull you back. So let's start with the ladders. The first ladder is starting early. When you invest early, time becomes your biggest advantage. Compounding works quietly but powerfully. The earlier you start, the less you need to struggle later. The second ladder is SIP. Systematic investment plans remove emotion from investing. You invest regularly whether the markets go up or down. SIPs don't make headlines, but they build wealth consistently. The third ladder is staying invested during volatility. Markets will fall. That's not a possibility, it's a certainty. Long term investors don't panic. They understand the volatility is the price you pay for growth. Fourth ladder, it is asset allocation. Equity, debt, and other assets each play a role. Putting all your money in one place might feel exciting, but a balanced portfolio survives long journeys. And finally, an underrated ladder, having guidance. You don't need to know everything. You just need to avoid big mistakes. That's what guidance helps you to do. Now, here's the most uncomfortable part. Most investors don't lose money because markets fail them. They lose money because snakes. First snake is panic selling. Markets fall. News becomes scary. Fear takes over. So investors sell right when they shouldn't. This single mistake has pushed more people down the boat than any other. The second snake is trying to time the market, waiting for the perfect entry, waiting for the right moment. Most people miss the best days of the market while waiting, and missing just a few good days can drastically reduce long term returns. The third snake is stopping SIPs during downturns. Ironically, downturns are when SIPs work best. Stopping them means missing cheaper units and future recovery. The fourth snake is chasing tips and hype. Hot funds, hot sectors, quick return. Short-term excitement often leads to long-term regret. And one silent stake many people ignore, no emergency funds. Without it, investors are forced to withdraw investments at the worst possible time. In snakes and ladders, you don't control the dice. But in investing, you do. Your dice is made up of discipline, patience, consistency, and long-term thinking. Markets move randomly, your behavior should not. The investors who win aren't smarter, they are calmer.
So, finally,
Mutual fund investing is not about speed, it's about staying on the boat long enough, climb the ladders, avoid the snakes, and keep rolling the dice of discipline. Because wealth isn't built overnight, it's built by making fewer bad moves over a long period of time. If you want your money to work smarter, play the long game. This is Kaapi Compounding, and like filter coffee, wealth is slow but worth it.